Hi there, I'm Edward Galstian, founder of EKH Capital, where we look for market-beating stocks for the long run. Today, we're breaking down Adyen, a Dutch full-stack payments platform powering global transactions for enterprise clients like Spotify, Uber, H&M and Meta. Adyen operates end-to-end across processing, acquiring, fraud and data analytics on a single platform, giving it an advantage over direct peers like Stripe and PayPal. This is fundamentally different from Visa and Mastercard, which operate the underlying card networks rather than processing transactions directly. As always, we're going to break down Adyen using our 5 key factors to determine whether it's undervalued, fairly valued or overvalued. We look for high returns on capital, strong growth, healthy financials, an undervaluation and a sustainable moat. If you find this helpful, be sure to like and subscribe. Now let's jump in. Great businesses start with efficiency. If a company can't earn strong returns, nothing else matters. First up, return on invested capital. Adyen sits at 9.8%. Now looking at peers, we use Visa and Mastercard as peers because they are the closest publicly listed companies in the global payments ecosystem, even though their network-based business models differ from Adyen's full-stack processing. Return on invested capital for Visa sits at 26.9% and is 40.6% for Mastercard. Visa and Mastercard achieve higher return on invested capital because they operate asset-light toll road networks that scale with minimal capital. Adyen, by contrast, invests heavily in its unified platform, processing, acquiring, fraud prevention and analytics, which requires more capital but gives deeper control over transactions. Next up, return on equity. Adyen sits at 25.1%, Visa at 50.7% and Mastercard at 190.6%. Mastercard's return on equity is extraordinarily high, but largely due to aggressive share buybacks, which reduce equity and artificially inflate return on equity. Visa also routinely performs large buybacks. Adyen does not buy back shares, so its return on equity reflects true operational performance rather than financial engineering. Adyen's returns are solid for a capital-intensive, full-stack processor, but lower than the highly leveraged, asset-light network models of Visa and Mastercard. Returns today are nice, but without growth tomorrow, the compounding machine stalls. Over the past decade, revenue grew at a compounded annual growth rate of 39.5%. Net income grew at a CAGR of 44.5% and earnings per share grew at a CAGR of 43.5%. Now versus peers, Visa's earnings per share grew at a CAGR of 15.9% and for Mastercard it was 17.1%. This is impressive. Adyen is growing faster than legacy payment networks because businesses are moving more payments online and want one system for both online and in-store transactions. Sustaining 40% plus growth forever is unlikely as the company matures, but so far execution has been strong. Even the strongest business models can crumble under weak balance sheets. Here's where Adyen stands. Total cash and short-term investments sit at 10 billion euros and total debt is negligible at 0.2 billion euros. Their debt-to-equity ratio is 0.1, which is very low, and their free cash flow is 1.6 billion euros compared to 0.2 billion euros in total debt. This gives us a free cash flow to debt ratio of 7. This is an exceptionally strong balance sheet. Adyen is essentially debt-free with massive liquidity, meaning it can self-fund growth without leverage. Unlike many fintech peers that expand through debt financing. Even the best companies can make poor investments when investors overpay. So how is Adyen valued today? Adyen trades at a price-to-earnings ratio of 41.1. Mastercard is at 34.6 and Visa is at 32.2. So Adyen looks expensive on this measure, but to adjust for growth, we use the PEG ratio. Adyen's long-term earnings per share growth forecast sits at 19.2%. This gives us a PEG ratio of 2.14. Now if you look at peers, Visa's PEG ratio is 2.5 and Mastercard's PEG ratio is 2.39. Despite having the highest PE ratio, Adyen actually has the lowest PEG ratio, meaning valuation is more aligned with expected forward growth than Visa or Mastercard. Still not cheap, but relatively fair for its growth profile. Does Adyen have a competitive advantage strong enough to sustain returns? Adyen's moat comes from its full-stack platform, which integrates payment processing, acquiring, fraud prevention and data analytics on a single system. This gives Adyen a clear advantage over direct peers like Stripe, PayPal, Checkout.com and Block, companies that often don't control acquiring in all regions or rely on partner banks for local acquiring. By controlling the entire payment flow, Adyen offers faster settlements, more reliable processing and better data insights for enterprise clients. Its global licenses and compliance infrastructure also make it difficult for competitors to replicate at scale, creating high switching costs and sticky revenue streams. Now, before we wrap up, the detailed financial charts in this video were powered by Fiscal, my go-to investment research platform. From November 26th to December 1st, you can get 30% off using my affiliate link below and no extra cost to you. In my view, Adyen stock looks fairly valued based on our 5 key factors. Returns on capital are solid, with return on invested capital at 9.8% and return on equity at 25.1%, but far below Visa and Mastercard. Adyen's growth is exceptional, with an earnings per share CAGR over the last decade of 43.5%. Adyen has an extremely strong balance sheet with near zero debt. Adyen's price-to-earnings ratio of 41.1 is reasonable relative to growth, with a 2.1 PEG ratio. Adyen has a solid moat, with a strong platform advantage over direct peers, but not a network effect monopoly like Visa and Mastercard. Adyen is one of the strongest high-growth fintechs globally, with disciplined financials and authentic returns. However, much of that quality is already reflected in today's valuation. Relative to peers, it's fairly priced for a premium business. Not cheap, but not irrationally expensive either. What's your take on Adyen? Drop a comment, hit like and subscribe, and let me know which stock you'd like me to cover next. Thanks for watching, and I'll see you in the next one.